Hello and welcome to Startup Street. I'm Shruti Mishra. These are the top headlines from the startup space. Flipkart bag logistics and delivery platform Shadowfax has set the price band for its initial public offering at 118 to 124 rupees per share. The company is gearing up to open its 1,907 crore rupees IPO on January 20, with the subscription window scheduled to close on January 22nd. FirstSource has acquired Telemedic, a Puerto Rico-based healthcare technology firm, as the Indian outsourcing and services provider looks to strengthen its digital and clinical capabilities in the US healthcare market. The acquisition would allow FirstSource to combine its automation and AI capabilities with Telemedic's operational footprint. Women's hygiene and wellness brand PSafe has raised $32 million in a funding round led by OrbiMed. The fresh capital will be used to expand offline retail presence, strengthen distribution, and scale sales across marketplaces and quick commerce platforms. Grow parent Billion Brains Garage Ventures reported a 27.8% year-on-year drop in consolidated profit for Q3 of FY26, impacted by a one-time gain in the base quarter. Revenue rose 24.8% year-on-year, and the platform continued to gain traction with strong growth in active users, market share, customer assets, and trading activity across segments. Jungle Ventures has elevated Arpit Berry and Rishabh Malik to the role of managing partner as the VC looks to deepen its engagement with founders and scale its footprint across India and Southeast Asia amid a broader pickup in early growth stage activity. Well, those were the headlines we've been tracking for you this evening. Now to the big story that we're tracking today. After a nudge from the Labour Ministry, India's quick commerce giants have all dropped the explicit 10-minute delivery branding. Shilpa Ranipeta joins us now with more details. Shilpa.
Well, you will no longer see the words 10-minute delivery in any of the branding of quick commerce apps, because after Blinkit yesterday, Instamart and Zepto too have dropped the explicit 10-minute delivery claims from all of their branding. Now, Instamart and Zepto apps until yesterday called themselves a 10-minute grocery delivery app on the Play Store or even on the App Store. But that has now changed to grocery and more for Instamart, while Zepto says grocery in minutes. Blinkit, remember, was the first to change the branding from 10,000 plus products delivered in 10 minutes to about 30,000 plus products delivered at your doorstep yesterday. Now, this shift follows meetings between the Labour Ministry and the three leading quick commerce platforms, with the government flagging concerns around rider safety and the pressure that time-bound delivery promises place on gig workers. But does that mean that your quick commerce orders will not be quick anymore? No. It's important to remember that this is largely a branding reset. On-ground operations are unlikely to change because delivery timelines are still driven by factors like dark store distance, traffic conditions, weather, and real-time rider availability. So if you have a dark store close by, your Blinkit or Instamart app may still show delivery timelines as low as 6 minutes, but no branding will put any pressure on any of the delivery executives. Now, experts also point out that the 10-minute promise functioned more as a marketing hyperbole and not a contractual guarantee, unlike what Domino's, for instance, used to promise with 30 minutes of free. And experts also say that this move now will instead shift the focus from headline speed claims to now consistency, safety, and operational execution for these companies. Back to you.
Well, thank you, Shilpa, for those details. Appreciate you joining us today. Also on What's Brewing, India accounts for nearly 10% of the world's stroke cases every year, and for millions of patients, recovery doesn't end in the hospital. It begins after discharge. This long neglected gap in India's healthcare system is now drawing investor attention. Out-of-hospital healthcare chain Sukino has raised $31 million in a Series B round led by Bessemer Venture Partners, with Rainmatter joining in, as it bets on structured, protocol-driven rehabilitation. Founded in 2016, Sukino operates 850-plus beds across 11 centers. It is profitable at the group level and is now gearing up for aggressive expansion across India. So can recovery care become as mainstream, as trusted as hospital care itself? Joining me now is Rajneesh Menon, the co-founder and CEO of Sukino. Rajneesh, welcome to Startup Street. Let's start with the core problem. What gap is Sukino solving in India's healthcare system, and how large is the out-of-hospital care opportunity? Where will this $31 million be deployed as you scale?
Well, hi Shruti. Good evening. Thanks for having me here. It's a pleasure to speak to you. Well, we just raised $31 million, and this is to take care of the out-of-hospital care that you just spoke about. Sukino as a company is into continuum of care, largely taking care of people who need such kind of care, especially in case of chronic ailment. When I say chronic ailment, I'm talking about severe cases of neurology, oncology, people with comorbidities and all that. And this is the very large market, a very nascent market, and we've been building very well. With this kind of a funding, we expect to kind of expand both geographically and also to take care of people with different ailments as well. Because currently, although neuro forms a very large element of our patient care, but beyond that, there are multiple other ailments which we want to take care of. Because as you know, most hospitals today, which take care of the acute care, are completely flooded, and it's our I think the model and our responsibility to ensure that we can cater to more and more people who need such a long-term out-of-hospital care network.
Picking up from what you just said, Rajneesh, hospitals focus on acute care, families are left to manage recovery at home, and Sukino positions itself in between. So walk us through your value proposition, the services you offer, and the price points at which patients access this care.
Yeah, fantastic. So as you rightly observed, the hospitals take care of acute care. When you say families are able to manage the care, remember it's not clinical care that they're able to manage. They're just able to provide some sort of a supportive care, not beyond that. What such kind of a chronic ailment patient, for example, a stroke case, as you called out earlier in your talk earlier, those kind of people, once their acute phase is over, once the surgery is over, they need about a few months of recovery. There are people who need even multi months of recovery as well. Now, this can't be unfortunately taken care at home, because if you take care of home by providing only some sort of a basic care, the chances of him getting readmitted back to the hospital is very high. So you need to ensure that such kind of people are given both recuperative care and also rehabilitative care. That's the most thing that goes hand in hand to ensure that this kind of people, the readmissions is not very high at that point in time. So that is a main value proposition that I bring to the table. I spoke only about stroke, but there are similarly conditions in the onco space where people are undergoing chemo and radiotherapy, whose bodies are weak. They need to be kind of energized better with therapy and with good diet and stuff like that. So recuperative and rehabilitative care goes hand in hand for such kind of a patient network. Now, as far as the families are concerned, they find this as a sweet spot because they're not able to take care of the loved ones in the rightest possible manner. Hospitals unfortunately cannot keep them for a longer period of time because whatever unit economics on the commercials and also the flooding of patients that they see day in and day out. So with these two aspects coming in, it is players like us, new models like us, which are going to be helping out larger and other people. Unfortunately, as you know, India is the capital of many diseases. And stroke and other neurological diseases are also something that we have a very large, higher numbers. Models like ours are the ones that are going to be helping them in the long run.
Yeah, Sukino, like I mentioned, is profitable at the group level, operates 850 plus beds across 11 centers. You've clocked 64% year-on-year growth. In a capital-intensive healthcare business, what has driven profitability and how do the unit economics stack up currently? And also the price points, if you can take us through that.
Oh, yeah, absolutely. When you say capital intensive, yeah, I mean, normally healthcare is always known to be a very capital intensive industry, but that's exactly what new models like ours come into play, where we try to be asset light. That's the unique differentiation between Sukino and the tertiary care hospitals that you find. Once Sukino has all the paraphernalia services that you see in a hospital, at the same time, it's an asset light model. So that helps us to kind of reduce the cost. Now, coming down to, the profitability and the unit economics, ultimately, Shruti, it's all about maintaining a good shop floor economics, right? I mean, you can make, as I say, you can make an ice cream in $10, you can make the same quality ice cream in $7. So all depends upon how you're able to maintain and control your cost. And this is something that we have learned and we have been practicing for the last 9 to 10 years since we came into operations. And I think we have the right model when it comes to setting up the right infrastructure to take care of the patients and with the very good recovery for them. So that's the other part. Now, on the front of the growth that we have seen, the 64% growth that you spoke about, indeed, for the last 5 years, if I look at the CAGR, it's about 51%. And I think this growth is going to continue simply because of the fact that there is a a tremendous amount of demand in the market, right?
Okay.
And we are,
Sure.
mind you, at this point in time with 11 centers, we're only catering to Bangalore largely, and we're catering to Kochi and in Coimbatore. The whole of At this point in time, the whole South India itself is open. A lot of metros and tier 1 cities in the north are open. So I think, there is a huge market out for people like us
Sure.
out there.
Very.
And I think if you find the right costing, the profitability is not going to be a matter.
Understood.
And it's not as capital intensive as the regular tertiary care hospitals is going to be.
Okay, one final question. We are pressed for time here. If you could answer that quickly. There are two very strong tailwinds: insurance coverage in expanding, which is expanding beyond hospitalization, and family is becoming more comfortable with institutional recovery. If you could tell us which is accelerating adoption faster. And, while Sukino is known best for, like you mentioned, stroke rehabilitation, your centers also cater to neurological, orthopedic, and oncology patients. As you expand, which conditions are you prioritizing next and why?
Right. I see three questions there, but I'll answer them quickly. The insurance care that you spoke about, right? I mean, that's a chicken and egg situation, because when the acceptability of the market is there, then a lot of people want that model. And when a lot of people want the model, they obviously want to ensure that the costs are covered by the insurance, right? And the insurance is also trying to see that as the scale grows up, they're able to kind of empanel a lot of people like us. So it's a chicken and egg situation between the family, needing our kind of a model and the insurance kicking in. So it's both. It works both ways. Now, coming down to your other question on the stroke care and other neurological conditions, Sukino, over the last about 8-9 years, when I look into it, 77% of our patients are in the neurological setup, out of it 54% is in the stroke care. But that doesn't mean that we are only catering to them, because as I told you earlier, we're into chronic ailment, which includes cancer, which includes ortho, which includes people with comorbidity. Anybody needing a long-term management of their health, those are the people with whom we are very, very, works very well with our model. It's not just neuro stroke.
Absolutely. And on that note, I'll have to wrap up our conversation. But many thanks, Rajneesh, for joining us on Startup Street today, and wish you the very best with all your aggressive expansion plans.
Thank you, Shruti. Thank you very much.
Well, moving on, at CES 2026, innovation was also about engaging the senses. Haply Robotics showcased haptic technology that lets users feel pressure and resistance in digital and robotic environments, adding the sense of touch to virtual experiences. Aishwarya Anand brings a special report. Take a look.
Okay, quick test. Close your eyes for a second and now imagine touching something online and actually feeling it. That's exactly what Haply Robotics is showing at CES 2026. And honestly, it's one of those wait, what moments? So here's the simple version. Most of our tech today can see, it can hear, it can even talk back. But it still can't feel. Haply is trying to fix that. They are building haptic devices, basically controllers that let you feel touch, pressure, resistance, and texture in the digital world. And no, this isn't just vibration, this is much more precise. I'm holding what looks like a fancy mouse or controller, but when I move it inside a digital environment, something crazy happens. I can feel when I hit a surface, I can feel when something pushes back, I can even feel the difference between a soft object and a hard one. It's like the internet suddenly grew a sense of touch. And here's why that matters. Think about designers sculpting a 3D object on a computer today. They can only see it on screen, but with Haply's tech, they can feel the shape as they design it, almost like working with real clay, except it's digital. Or think about robotics training. Engineers can guide a robot remotely and actually feel what the robot is touching, helping machines learn how much force to apply. Too soft, too hard, Haply's tech lets humans teach robots using touch, not just code. Even in gaming and virtual reality, this changes everything. Instead of seeing a virtual object, you can feel it, push against it, sense resistance. Suddenly, the digital world doesn't feel flat anymore. And the coolest part, Haply isn't trying to build a toy for consumers. They are building the touch layer for future tech. Something that can plug into VR and spatial computing, robotics and physical AI, 3D design and engineering, training and stimulation. Basically, they want touch to become as noble as sight and sound in technology. At CES, while everyone is talking about AI brains and smarter software, Haply is reminding us of something more important. Intelligence isn't about thinking, it's also about feeling. So, if the future is going to be more immersive, more human, and more physical, someone has to teach machines how touch works. And that's exactly what Haply Robotics is doing. From CES 2026, this is Aishwarya Anand for CNBC TV18 in Las Vegas, showing you how the digital world is finally learning how to feel.
Well, with that, let's slip into a short break. Up next, AI services firm AIVAR has raised $4.6 million in a seed funding round led by Sovereign Investments with participation from existing investors, including Bessemer Venture Partners. We catch up with Kaushik Rajendran, the co-founder and CEO of AIVAR, to decode the firm's growth plans. Stay tuned.
From Bessemer Venture Partners. Operating as an end-to-end AI studio, AIVAR spans strategy consulting, custom AI solution development, and managed AI operations, and it claims to have scaled to more than 80 customers in under a year. The startup says this new funding is going to be used to expand their presence across the India, US, and the Middle East, while also continuing to invest in the AI accelerators, senior talent, and global delivery capabilities. For more on this, joining me now is Kaushik Rajendran, the co-founder and CEO at AIVAR.
And this will help us to strengthen our India market, at the same time expand in US and Middle East meaningfully. We also have plans to
in less than a year. What does that translate to in revenue today for you, and what kind of run rate are you exiting this financial year and say the coming year with?
Absolutely.
Welcome back to Startup Street. Let's take you back to the Consumer Electronics Show. ininim is reimagining personal fragrance with a smart device that allows users to customize and switch perfumes based on mood, outfit or occasion, all from one gadget. Aishar Anand brings a special report. Take a look.
How many of you wear the same perfume all day? Morning meeting, gym, dinner, same scent. Well, ininim says that makes no sense anymore, and this little device might just change how perfume works forever. So what ininim has launched here at CES, it's been called the world's first AI-powered personal fragrance device. In simple terms, this isn't just one perfume, it's many perfumes in one device. Inside, there are 3 fragrance pods, and using an app, you can blend them, control them, and change your scent in real time. Morning, light and fresh. Evening, deeper and stronger. Big meeting, confident. Workout, clean. Same device, different mood, different moment. Watch this. I am literally changing my fragrance right now. No mixing bottles, no layering, no perfumes. Just sliding controls on the app. In fact, one device can create 100+ unique fragrance combinations, and you can tweak them instantly through the day. So I'm bringing the conversation now directly from the founder, where let's just ask him some interesting questions about what this whole thing is. So, Marco, my first question to you is that perfume really hasn't changed in decades, right? So what actually made you think it needed a tech upgrade?
Well, exactly because of that, because it hasn't changed for decades. So we wanted to bring technology into this segment, and actually the main thing we wanted to do is personalize the fragrance.
So if I have to understand, how many such fragrances have you launched right now?
We have 5 altogether.
And how are they priced?
$29 each.
Do people have to pay extra for this app?
No, it's included in
It's
the
included
price.
in the price range.
Yeah.
Okay, all right. ininim isn't selling you a fragrance. They're introducing what they call personal fragrance technology. The scents themselves are EDP, made in Italy, designed specifically to blend, meaning each pod works alone or together. So this isn't a gimmick, it's luxury fragrance made flexible. At a time when everything is getting personalized, from playlists to skincare, ininim is asking a simple question: why should your fragrance stay stuck in one mood? From CES 2026, this is Aishwarya Anand for CNBC TV18.
Well, with that, it's a wrap on this edition of Startup Street. More news and updates coming up on the other side.